Evening traders, it's Simon at Kairos Capital Markets. Today's video we're going to touch on smart limits, smart stops with capping your actual risk, so cap how much you're going to lose, and a little bit of trade management and risk management all tied in together. So it's a bit of a skewy kind of video, but it will put a lot of information together. So firstly, I want to highlight here, this is the Aussie dollar daily chart, and these are the trades I've taken since the middle of December last year. So I've taken one trade here, 2, 3 and 4. I am waiting for another one here, so ignore that for the moment. So just to let you know, we've won 4.9%, 4.97% there. We lost 1% here. We made 4.3% here, and we made 1% here as well. So when you add all that up together, let's see, we've got 4.97 minus 1% there, plus 4.3, which is that one there, plus another 1% as well for the small one at the bottom there. So on this chart here, I've made 9.27%. I have, and I've got a 75% strike rate there. So 3 out of 4 wins is quite nice. That is. So divide this by 4. My average earnings of a trade is 2.31%. So what we'll do is now is we'll go into the Excel document, and I'd like to show you this. So let's just delete this all for the moment. The average is 2.31%, and my average loss is 1% because I only ever lose 1% maximum, by the way. So the average is always going to be less than 1%, but just giving an example, the average loss is 1%. So if I was to take 100 trades like this and win 75 of them, which I've done already, my average yearly returns would be 148%. Now that equates to roughly about 12% per month as an average. So 148 divided by 12 equals 12.3% as an average per month. That's my average return. But what I want to show you though is look at how little I trade. Now, you know I take 2 trades a week roughly as an average. Just as an average, 2 trades a week. Sometimes I might take 1. Sometimes I might take 3. I may pick more than 3 trades, but I'm always looking for what I can do there. So the idea really is to cap your risk, but try and get as much as possible in your reward. And you have to understand why you're doing this. So in all fairness, let me give you an example on this trade here. So with this upward sloping trend line, we're going to break down and then come back up to test the daily 50 and 200 EMA, a key level with a doji, which was quite nice. The weekly lined up quite nicely as well in this trade, and I thought, where's the next logical limit? You could say the logical limit was going to be at this black line here to make a double bottom, but because I felt that we broke out onto a bearish trend here, the bearish trend was looking to continue. And if you look here, we had resistance, you've got support, resistance, resistance again. So for me personally, I was like, I don't want to trade through this. I'd like to have a break and retest of this to trade again. Now what happened was we broke down, tested it, then come back again. And I actually looked on this pair here. It's actually on this bearish inside candle. Sorry, I actually took the trade the next day because I thought the intraday looked like they changed. They looked like a very good trade. I lost 1% there, but that's not to say the trade wasn't bad. The trade was a good trade. It just powered up quite nice, as you can see. It powered up quite a lot. But why did I put my stop here? Well, put my stop above. Just to give an example here, I did put my stop above these 2 highs here because I wanted the best stop protection possible, and still 2.6% is a pretty nice little return. Now, the next thing you have to understand is I don't take a trade for less than 1%. So this small one here, which you saw a couple of weeks back, that was a little mini 1-to-1 trade. That's the lowest I will go. I'll go into details why. Now again, this trade here, the smart limit would have been, if you notice how we powered back up again, and I'm thinking, well, we powered through this level here, we may have a bounce off this, and we've got again the daily 200 average, the weekly average was there, this key level, so I was like, I want to get out before that. So again, smart limits here is telling me get out before we actually do that. And notice how I don't get out at the key level. I get out a little bit more before that. That's about 10 pips before that was. So people said, oh, you can push it to this like that there, get an extra 0.2%. How pathetic. If you have a large account, you don't want to try and squeeze the very, very last 0.1% out, because if you can imagine, it can move back against you by 1% in a day, no issue at all. But you have to wait an extra day just for that 0.1%, and that means you've got to get it right 11 times out. Well, yeah, you've got to get it right. For every 11 times you do it, you've got to get it right. No, 12 times. Every 12 times you do it, you've got to get it right 11 times. And that's a lot of stress and a lot of aggravation, where trading shouldn't be really that stressful. So really what we're looking for then really is, that's why we take the smart limits there. Again, this one was highlighted in the daily direction predictions for that. So my next trade now I'm looking for is this one here, and we'll wait for that to come up. But what I'd like to show you now is what happens is when you edit these figures here a little bit. So the win rate is still 75%. But when people scalp, they go, hey, I've got 4 pips. And you go, yeah, but 2 pips of that is actually spread. So you only got half of what you did. So your 4 pips stop, if it was going to do 4 pips, for example. 2 pips is spread. So technically, for you to actually win 4 pips, you should have gone 6 pips. But you never did. You got 4 pips, of which 2 pips are spread. So yeah, it's 0.5% risk. So win already. If you do a 1% loss, just an example, that's only half to 1 ratio. That's only 12% per year. So that means you've got to start picking more and more and more trades just to get there. And all of a sudden, these trades the best trades don't turn up all the time like that. So you've got to start increasing. And what normally happens to this is you don't win 75%. You might win only 70%. And all of a sudden, you're winning 5% for the year. In which case, you've got to do 1,000 trades per year and still make 50%. 1,000 trades a year is quite a substantial amount, unless of course you're doing high frequency trading. But 1,000 divided by 52 is 20 trades a week. So you still got to do 4 trades a day, and they've got to be in and out trades all done, and you've got to have this high strike rate here. So this is why I only ever do 1-to-1 minimum, because the minute you just go 1-to-1, you've increased your profit massively there. Look, 0.5, you're making 50%. Make 1%, you're making 400% per year. Go for 1-to-1. Don't go for anything less. It's not worth it. It's not worth the stress. It's not worth the aggravation. And to be quite honest, people like me, it's just you're just biting at little bits and stuff. Right? It's nothing. I like having a decent amount of pips and a good reward for my efforts. And if you're going to trade 5 trades a day, 4 or 5 trades a day, you got to go for 1-to-1 still, no matter how you do it. So if you've got, say, a 4 pip target, and then you got to understand you got your spread as well there. If you can get out with all your cost of trading 0.5 pips, for example, that still only leaves you 3.5. So that's 0.8, I believe, percent. You see how the figures still skew themselves massively, and you still need this high strike rate. Let's say, for instance, you get that much right. Then you need the high strike rate. That's different. So less trades, better trades, and actually and just take the best ones and just go for a far better strike rate. I mean, increase your average win. Simple as that. Go, I want to take trades that earn me an average of 3.5%. Fine, fair enough, do that. And then actually take less trades. So you can probably come down to, in the end, you can take 20 trades, win 18 of them. Just an example of 3.5%. Just understand, you've only risked 20% of your account in total for the whole entire year. This is the difference here, you see, yeah? And you made 61%. So it's all about risk to reward here, you see. This is what trading's all about, risk to reward. And what I'd actually really would like to explain to someone and drill down properly is for people to understand is you want to increase your average win, and you want to win the trades won, and then you want to increase, just get the best out of it. You may find, I found 50 trades that are really, really good, of which 45 won. Just an example. There you go. 152%. That's all you need, guys. You don't need mega amounts of trades. Just need high quality and good winning trades. That's all you need. Guys, I hope that helps you out a little bit, and I will speak to you soon.